Welcome to today's Financially Speaking Monday morning briefing. It's an absolute pleasure to be here for the second Monday of the year, of course, and to be back and see all of your lovely faces. I'll just share my screen now so that we can hopefully see what we're all here for, which is today's Financially Speaking, as I say, Monday morning money briefing. So just having a few issues with that. Hopefully it'll come through relatively quickly. Here we are. Gosh, that's just what we need, isn't it? A few technical issues for first thing. But we are now up live and ready, and hopefully all of you can see that. I'm also just going to share as well the link in the chat now to ask any questions that you might have whilst we're going through. So if you do have any questions, you can always ask away. I'll come to them at the end, just so you know. If you do ask anything whilst I'm going through, it's not that I've missed it. It's just that I'll come on to it afterwards. This is recorded as well, and we do always share the recording afterwards. So if there's anything that you want to come back to, you always can do. You can always check back in. And of course, if you are watching this afterwards, you're not joining us live, then hi, hello, it's a pleasure. You can always drop your questions through to us as well at hello@myfinancialfreedomcoach.co.uk. And I do always say, if you see anything in the headlines in the week that you're really scratching your head about or want to know a bit more, do just drop us a message on there and we'll do our very best to weave it into whatever it is that we're talking about on Monday morning, because I know sometimes how helpful it can be to have somebody dive into it. So if it's applicable, we'll do our very best. But I'll dive into what we're all here for this morning, which is this morning's Monday morning money briefing, where we break down the major headlines of the week. If you're new here, hello and welcome. And here is the agenda. If, of course, you've been here for a few weeks, it's always great to see familiar faces, then you'll know what we're up to. But in these Monday morning money briefings, as per usual, I'll go into one thing that I myself have done to get a little bit closer to financial freedom before going into what has happened in the UK, over the pond in the US, taking a look at a read of the week, Europe, and the rest of the world as well. So one thing that I've done to get me that little bit closer to financial freedom this week, because that is what we're all about here at Financial Freedom Coaching. So it's a bit of a out there one. One thing I've done this week is really to think about my number. And when we talk a lot about financial freedom, this number is kind of key. And I think, to be honest, it needs a whole other webinar on it, which we might come on to in the coming weeks or indeed even months. Or, of course, if you do participate in any of our coaching, be it through our individual or group sessions, then you'll see very much what we're talking about when we mention this number. But essentially, the number is how much do you need to be financially free? And that number will be different for me, for you, and for anybody else sat next to us or joining us or anybody that you speak to today. Because what financial freedom means is something different for all of us as well. So this number comes from looking at things like how much do you want to spend? What does that lifestyle look like? How much do you need to cover the basic overheads in the country, the city that you live in? And basically, this number helps to keep you on track with where your investments are at and what your spending's at, and making sure that you don't fall foul to the likes of lifestyle creep, which is pretty common. So we see that as people earn more, generally they want to continue spending more. And so that number can just keep on growing. But it's really important to keep that in track. So I've done some little recalculations around my number, not quite firmed up yet, but certainly some thinking into the new year, a little bit more holistically, if you like, about what my financial freedom looks like into this next chapter of my life. Some of you might know that I got married late last year, so we're just thinking about what that looks like as the two of us, and of course, what financial freedom looks like going forward as a duo as well. So what can you take away from this then, this bright and early Monday morning? Well, the thing that you can take away is that have a think about what freedom actually means. It's not normally something that you'll come to an answer on straight away. I certainly haven't come to an answer on the exact number this week, but we've put some numbers down and started to figure out what it might look like. It's a process. And that is why, of course, within coaching, for example, we do multiple sessions because it often requires quite a few. So, but start to have a think today about what freedom means and what financial freedom therefore might mean as well. We'll dive now into the major indexes for the week, thinking about some of the nitty gritty of your investments. So, this is how the major markets have performed in the last week. The FTSE 100, which is a measure of the 100 biggest companies in the UK, ended the week up by 1.74%. The S&P 500, a measure of the 500 biggest companies in the US, ended the week up by 1.07%. The NASDAQ, which is the US tech based index, ended the week up by 0.95%, whilst the Eurostox 50 really zoomed on in with a gain of 2.29%. And that is a measure of the 50 biggest companies in the Eurozone. So what this really shows is that last week, which is really the first full operating week on the markets, was pretty strong across the board. It might not have felt like that from some of the headlines that were flying around in the week, which I'll come on to dig into as well, but it's certainly been a positive tale to kick off the year. So do have a look to see if your investments compare. Hopefully they will be showing relatively green and relatively strong as well. The more that you come and see these figures, the more relevant they become, because you start to see that, for example, the Eurostox 50 up by 2.29% is really quite a bumper week. That is quite strong. The Nasdaq being up by 0.95% is still an up. It's still a positive. We'll take it, but it's not necessarily something super huge. But what all this means is that you can start to understand some of those changes and some of those fluctuations that we see in the major indexes across markets and therefore in your portfolios as well. It can also help to rationalize some of those big ups and downs and when they may or may not be relevant to you as well. So, on to then what has happened in the UK, where actually it's been a relatively quiet week for financial news in the UK. But what we saw is that actually the EU has demanded various different legal safeguards, whilst the EU and the UK work through the post Brexit agreement. This post Brexit agreement is opening some doors once again, which many individuals and sectors are relatively happy and relieved about. Since Brexit for the UK, many different tariffs essentially have come in, which have proved costly for various different industries. It can also mean a slowing in the supply chain, so things take longer to get through customs, for example, because there are more barriers in place for trade between the UK and the EU post-Brexit. So this deal that is being laid out is set to open a few doors again, and as a result, a lot of infrastructure is going into it. So what the EU has demanded is a so-called Farage clause. If any of you are familiar with the politics of the UK, which you might be if you sat here, of course, then we'll all be familiar with the name Nigel Farage. He is the leader of a relatively right-wing party that has been very vocal about leaving the EU and continuing to close that door and that relationship, essentially. So what the EU is saying is that they need to have some sort of reassurance that if he did get into power at the next election, which would be 2029 here in the UK, then they want to know that the penalties for exit would be relatively high and would make sure that they recouped any costs spent on it. So this deal is, as I say, most would see as relatively positive. But what does it mean then for you and your investments? Really, what it means is that certain sectors, including food, drink, and agriculture, may well benefit from these doors being opened. They are sectors that have seen particularly large hits to the increased tariffs and costs on trade between the UK and the EU. So what this might mean is that the UK domestic sectors in those areas face a bit of a boost as these barriers come back down and things get a little bit cheaper. It might also mean that UK domestic consumers, so anybody living in the UK, sees an ease in buying from some of these areas. You may well be familiar, if you are in the UK, with the likes of dairy, chocolate, olive oil, all shooting up in price. Now, there's different reasons for this. It's not all Brexit, but as we know, some of these produce have become more expensive due to the tariffs that have been put in place. Things might just get a little bit cheaper. So overall, it's relatively positive news. It's kind of convoluted because it's come from the spin that they wanted this Farage clause in place. But basically what it's saying is that post-Brexit, we are now opening some doors, and that could mean some good things for various different industries. On to then over the pond in the US, where I think it's fair to say it's been a relatively dramatic week. Over the weekend, so last weekend, not this weekend, just gone, we saw military action take place in Venezuela from the US military. In the aftermath of this, we also saw the president of Venezuela, Nicolas Maduro, be arrested, taken to New York, and put immediately on trial. We've seen various other threats come from Trump as well in the week that has followed. These include on other nations such as Cuba, Colombia, and Greenland, some of which I'll come on to talk about as well, whilst also announcing big changes to the way that Venezuela's run and notably to their oil industry. Many believe that this military action is really because the oil reserves that are in Venezuela are relatively significant, and Trump himself wants to get access to these to be able to generate more revenue for the US, essentially. So, despite the furore of geopolitical tensions that have taken place, US equities and their stock markets, as we saw at the beginning, are looking relatively strong. Defense stocks had a bit of a rocky week. They were told earlier in the week, last week this was, that actually they weren't going to be able to do various things, so make changes to, for example, the way they pay dividends or the way they rebuy stock to essentially influence the price of their shares, and this caused them to plummet. However, they came back up again when Trump announced that he would be spending more money in defense, which is kind of obvious from what took place at the beginning of the week. As with any conflict, there are always difficult sectors, and there are always sectors that emerge relatively strong. It may kind of sound macabre, but essentially in war times, it sounds obvious, but if you look at defense stocks, they do often perform very well, because that is where the main focus of a lot of government spending is going, and of course, private sector spending as well. So, what could all this mean then for you and your investments? Well, first up, if you've seen the headlines and feared lots of bad things, then most investments across the globe, including those in the US, which most of us will have, are looking relatively positive. So, it's yet another warning to not just believe the headlines, but always check what's going on in the financial markets behind the scenes as well. We could also see that there are strength in certain sectors, defense being a key one, for example. You might be thinking to yourself, but what about oil then? Because he's gone into Venezuela clearly with the agenda of focusing on oil. I'll come on to talk about that when we look at the rest of the world. But it's worth noting that at the moment, Venezuela is a relatively minor dot. In fact, it produces around 1% of the globe's oil supply. So it's really not that much. Therefore, the impact on oil prices from the week has been relatively minimal because it's going to take time for that oil production to be harnessed. And frankly, it's not got that big of an impact on the global supply as it stands at the moment for us to see a major change in the prices. So, whilst it may well play out long term, there's not a lot to write home about that within this week. There may well be other sectors as well that boom and bust from Trump's ongoing rampage, but all we can say about that is who knows what next week's going to bring. I think if you joined these Monday morning market briefings last year when we were following the likes of tariffs and whatever else was going on, it's just endless surprises. That's all I can say. None of us can quite predict what is necessarily going to come next. On to then the read of the week, where the Financial Times was digging into various different professional fund managers and how they're preparing for a reckoning in the US tech sector. This was a key theme that rumbled on throughout 2025, and it's all about an AI/tech-based bubble. Many fear that there are major overvaluations within the AI sector, and it's likely going to be a conversation that continues on into 2026. The reason why this was included as the read of the week is because it is a topic. People are going to keep talking about it, and it is going to be something that's niggling away. For most of us, if you've got investments in the US, you're heavily exposed to tech and AI because it makes up a huge section of their overall stock market. Even if you're not exposed to the US, you'll still be exposed to tech in a wider sense. Let's be honest, we use it all the time and it forms a major part of lots of different stock markets and portfolios. But the same with AI. So, keeping up with this ongoing analysis and commentary is useful for understanding what is going on with your investments and also trying to keep balancing those books, because what I personally see is that it's just ever changing. AI is still so new, and it's not something any of us would have predicted necessarily 5 years ago to have been such a big topic. And that change is rapid. So we have to hold on tight and be ready to pivot. But crucially, we also have to be and remain diversified wherever possible. I think all of this talk around the AI bubble and really the lack of it playing out quite yet is just really highlighting the need for balancing those balls and keeping eggs in multiple baskets, whatever analogy you want to use, but trying to keep those investments as diversified as you can to rationalize the potential impact that any sort of bubble bursting within the AI and tech sector may well have. So let's take a look then at Europe, where Greenland came under metaphorical fire from Trump as he threatened Greenland once again. Greenland is an almost independent territory, but it does belong at the moment to Denmark. NATO has remained mostly silent on this topic. It's a very difficult one, as the US is in NATO, as are Denmark, and as are the UK and many other major nations, including France, Germany, and other European countries too. Denmark has specifically warned that any US attack would undermine the NATO alliance, which was set up after World War II, and it would also undermine any credibility that NATO may have had to have stuck together, essentially. The security commitments that come from NATO could also change. These stipulate that every nation that is part of NATO has to spend a certain amount on their defence. So it's just more ongoing geopolitical risk. What this kind of means for your investments is that expect volatility. We're not in calm times, if we ever are, but these are particularly volatile times. Again, defense and energy may well be the ones that benefit from this, because as we start to see the likes of more threats come out, it only goes to show that the likes of Denmark and other nations that fear their own sovereignty or their own potential threats too may well spend more on military too. But it just underscores that importance once again of diversification. We just don't know what he's going to go for or where he's going to go, if it's just an empty threat or if actually there's something behind it. None of us can predict that future, so hold tight with your investments and keep them spread. And then on to Italy, where the Prime Minister of Italy, Giorgia Meloni, in a 3-hour-long press conference on Friday, blamed Germany essentially for an economic slowdown in Italy. A lot of finger pointing went towards the EU Green Deal, which she believes has particularly harmed Italy's automobile sector, which is traditionally one of their biggest exports. She also mentioned various different promises to try and support economic growth, which has seen quite a significant slowdown in Italy. So what does all this mean then for you and your investments? Well, Italy is a major nation. It's a major player in the Eurozone. And within that, for example, Euro Stoxx 50 as well, they have some quite significant players on there. Weaker growth is never really great news. Neither is jabs between the major leaders of major nations across the Eurozone. But Italy has faced particularly high energy costs. This has put a lot of pressure on things like wages, jobs, also public finances, and it's also influenced, of course, inflation. So all of this has just been a bit of a cloud hanging over Italy. Hopefully, now that we're coming out of the other side of what was a bit of an oil crisis, I don't like the word crisis, but we certainly saw after the invasion of Ukraine in 2022 an increase significantly in oil prices. It's starting to settle down. This may well change. So for your investments, this means there's just a bit of a rumbling in that Eurozone. If you've got, for example, ETFs in the Euro Stoxx 50, then you might see in the medium to long run some tensions. It's not totally calm, but there's certainly plans in place to try and boost some of that growth and hopefully drive growth within investments as well. On to then the rest of the world, where first up, An IPO in Hong Kong of a company named Minimax saw a whopper start to their time on the stock market. So, for anybody that's unaware, an IPO is simply standing for initial public offering, and this is the first time that a company lists on a stock market. So, the first time it becomes available for the likes of you and I to buy their shares. They're closely watched. Over the last few years, IPOs have been a bit of a flop. So what that means is that they've gone up for a certain price. So the company gets valued at a certain price, and then it gets broken up into the tiny little sections known as shares that we buy. And what has happened with a lot of companies is those shares get valued, and then unfortunately they drop quite a bit. All of this has been to do with various different mechanisms within the markets and the economy. Some people suggesting overvaluations, and also various different climates that have taken place. But what we've seen with Minimax is that it's surged. It actually doubled in value. This really reflects a strong demand for AI. So it's the second Chinese large language model to have listed on a stock exchange, and the valuation soaring does seem to suggest that people want to buy it. So all this talk of an AI bubble and tech valuations, does it add to it? Possibly it does. It adds to the narrative that there's a lot of hype, but it also adds to the narrative that actually there is really something in it, and there's still a lot of excitement and belief in what AI could bring to us. Botswana, meantime, launched a citizenship residency scheme. This is amid various different economic pressures. They're essentially offering the ability to get citizenship if a certain amount is invested. Critics warn that the benefits often fail to reach the real economy, but what Botswana believe is that this may well help boost various different industries, from construction to property to green energy as well. It remains to be seen, but it may not be the only one that we see pop up of this ilk. It's certainly a new and not new necessarily. It's certainly becoming a new popular way to incentivize people to move and also to generate investment into a nation. So, what does all this mean then for you and your investments? Because it's unlikely that you've got investments into Botswana, for example. But what it shows is a shifting way in which countries may well be attracting foreign investors. They're looking more towards individuals rather than necessarily broader nations or corporations. It's suggesting that actually that way that we've seen things shift is that there are individuals out there that are considerably wealthier than entire nations or indeed other companies. And what this shows is that there's just things to watch out for within that global economic sphere. Not necessarily anything to do straight away with your investments or anything that you'll see impact or play out, but certainly an area to watch. And last but not least, for the rest of the world, we couldn't go without speaking about Venezuela. Trump has reportedly said that he wants to invest at least 100 billion into Venezuela's oil sector. However, this has come with various different caveats, question marks, and potential difficulties from oil companies and other players in the industry as well. There are not many oil companies that are still operating in Venezuela. Chevron is the only US firm that's still there. There is Italy's Eni that operates in Venezuela, as well as Spanish, and the names totally escape me now, but I think it's Enprom. As I said earlier, Venezuela only represents 1% of the total output of global oil. It's quite small. And what's happened in recent years is that there's been takeovers by the Venezuelan government. They've seized various different assets of the likes of American oil companies. And this has meant that there's been disinvestment. So there's a lot of rickety old oil rigs, for want of a better word. And it's going to require an awful lot of money, but also a lot of faith from companies that have seen themselves lose a lot of money in Venezuela in the past. So to meet Trump's wishes due to these sanctions may well cause some question marks. Whether it pans out, who knows? So what does this mean then for you in your investments? Well, it means that headline of how much Trump wants investing in Venezuela and oil companies that may well do this might need some fact checking. It certainly doesn't mean dash towards oil as the next big thing. Many experts in the sector are saying, I'm not so sure that 100 billion is realistic, not just from actual realistic spending, but also desire as well. watch this space is all we suppose I can say. But you can take it away that your investments probably won't have been affected too badly in the negative from this week. So thank you so much for joining this morning. If you are here live, do feel free to ask away if you've got any questions. Hopefully you can all see that link. I'll just send it again as well into the chat. I did make sure that I pinned it just in case there were any issues. But as I say, if you are watching this recorded, if anything comes up in the week that you want to ask about, you can always drop us an email on hello@myfinancialfreedomcoach.co.uk, and we'll do our very best to get back to you and answer. It's worth noting as well that we are also launching a waitlist for our group coaching sessions, which I spoke about a little bit last week, where we'll essentially be working in a cohort of individuals, all within boundaries of confidentiality, but to strive towards financial freedom. Group coaching is a little bit different to one-on-one. It tends to be more reflective on the personal self, but also more of a learning journey from others too. Both have their pros and cons, if you like, but both can be really beneficial for hitting goals, setting goals, and really having some accountability as well. So if you're somebody that likes working in groups, likes getting to know other people and talking to them about the likes of finances, then that could well be the one for you. You can sign up to that on our website. And if you do have any questions, you can always book an intro call with one of us, which is 15 minutes, where we just chat to you about how it all works. So hopefully you can find that on what's on screen now. I'm just going back to the questions. I can't see any questions coming in. Hopefully, if you do have any, you're able to ask. I think all good, so that's great. Nothing coming in. Hopefully that answered all of your questions for the week, and I'll look forward to seeing you all next week as well. Bye for now. Have a lovely day, and all the best.